Good morning, Richard Calhoun, Creekside Realty, 40 years of working with buyers and sellers here in Silicon Valley. We're here today to talk about week number 50 of 2021. The URLs that you've been used to will be changing at the new year. I'm going to start abbreviating real estate market graphs as Silicon Valley real estate market graphs by just using the first letter. Overall, the URL shrinks, but it's changing. And then the concept stays the same. The new root URL that will start in 2022, which is only 2 weeks away from today. You add 2022 and you would get to the live presentation. You add the year, month, date code, and you get to the specific episode and then the handout. So here's the first data slide. We're looking at two things, supply and demand. The reason there's three lines is the blue line down here is total supply. This is essentially the water in the reservoir. How much inventory is there out there right now for buyers to go buy? You can see it's 60% of the 5-year normal. The 5-year normal I use are 15 through 19. The 5 years just before the pandemic, but those happen to be 5 great years. So when you have less inventory than strong market inventory, you have a stronger market inventory, and that's exactly what we have. There's essentially no inventory out there. Buyers are going crazy. Then the next gray line is the number of new listings that are coming on the market. So this is just how much water is coming into the reservoir. And you can see there's huge perturbations for the holidays. That was Thanksgiving. We're coming into a perturbation for Christmas where there's more listings a week before Christmas. The week of Christmas, this will drop back down is what I would expect to have happen. Red line is the flip side, the demand side, and you can see the demand is picked up as soon as the new inventory picked up, which is what I was expecting. In other words, this drop in demand wasn't really a drop in demand. It was a drop in available inventory for buyers to purchase, forcing a drop in the number of new offers accepted. Here we're just looking at raw count, days of unsold inventory. This is a theoretical number. How long would it take to sell all the existing listings if no new listings came on the market at the current rate of sales? It's a mathematical calculation of how fast the market's going. The lower the number, the faster the market. It's the turn rate. So right now you're down here somewhere around 15 days. So everything that's on the market in both counties, both types of property, single family, condos and townhouses, would sell in basically 2 weeks. You can see everything below 40 is shaded red. That's because 40 and below I consider to be a red hot seller's marketplace. From 40 to 80 is a balanced marketplace. Above 80 is an ice cold buyer's marketplace. Spend very little time in a balanced marketplace. And basically since 2010, we have been in pretty much a red hot seller's marketplace. Now, if you go back to 10, people might argue with me, yes, we were in a balanced marketplace, but we were transitioning from a ice cold buyer's marketplace to a red hot seller's market, and it took about 2 years to transition. So basically from 2010 through 2012, we were coasting down through this white area. And then basically from 2012 onward is my recollection, we were down here. And I'm doing that based off the top of my head and not on data, so I could be mistaken. The blue line is the current data. So you're down here, it's 15 days. The 5-year median, you were somewhere up around 35 days. So we're much faster than the 5-year median, which were 5 great years. In fact, this is basically the record low number for the valley as a whole. I don't have data for this because I used to always only look at micro market. And with the pandemic, I started looking at the macro market, and the macro tends to be slower because not every area moves as rapidly. So for the macro data, I'm pretty confident, but don't have the data to support it, that this is the fastest market we've ever experienced. This is looking at the buyer side to some degree. This is looking at the sale price, list price ratio of every transaction for the past 22 weeks and plotting it out on a graph. The current week is this purple line coming down through here. And I've made this observation before, and I'll make it again, is it's getting steeper for some reason. And I really don't understand. You can see it's the absolute best line up through here. And right about here, it starts dipping down. And then you come down here and it's sort of in the middle of the pack. What's the significance of that? I actually don't have enough experience noticing this pattern to realize what's going on. My best guess, and this would sort of fit into it, is it flattens out towards the end of the month. And the reason for that is the end of the month is when buyers that are cash strapped are tending to close escrow because the prepaid interest is lower, less significant at 3% interest, but in the middle of the month, it tends to go up a little bit, or if the market's starting to improve, it tends to go up and on the high end. And so this could be just the middle of the market going up at the high end. And you can see the green line right through here was up, and that was about November 13th. So it's about the middle of the month. It was also sort of doing the same trend. So I'm going to just try to keep an eye on it. I'm not sure that's real significant. I think the significant takeaway on this line is as you go up to the right, the market's improving. The dotted red line is the best month we have ever had. All the data lines are weekly data. The blue line is the worst month we ever had. And so you can see we're, bouncing around quite a bit. And that's basically, I think, the major takeaway from this slide is we're mostly bouncing. But now if you really start looking at it, the solid lines are the most recent 8 weeks. So the worst performing is down here, and that's still in the top half. So the last third of the data weeks are all in the top. So I would actually say that this is starting to suggest that the market's creeping up a little bit. And there's several indicators that that's exactly what's happening. My overall speculation is we're starting to pull some of the 2022 price appreciation that everybody's anticipating into 2021 simply because there's no inventory available. This is looking at some of the micro market data. It's the key components. DUI is days of unsold inventory. That's the key one. Well, anytime you have these numbers in single digits, that's just outrageously fast. And, Foster City at 2 days, it's a very small micro market area, so it's really not statistically significant. But to sell everything that's in there in 2 days is just absurd. I mean, I don't even know what to say about things like that. Frankly, anything under about 3 weeks is faster than the market really can support. And basically everything on here is faster than 3 weeks, except for the expensive areas in San Mateo County, which would be Atherton, Menlo Park, Portola Valley, Woodside. Saratoga Las Gatos is right at the cusp there at 22 days, and the San Mateo County at 24 days. So there's a few areas that are right at the 3-week benchmark and only one that's over there. Everything else is down around 1 week, 2 weeks at most. And that's, a week and a half. That's just insane. Condos are a little bit slower, but they're pretty rapid too. And that's fairly interesting when I make some of my observations later on condos. The frequency of overbidding is in this column. And you can see again, the high frequency of overbidding. The redder the color, the more the frequent overbidding. So pretty quickly, you can see the Cupertino Sunnyvale appears to be the most overbidding at 94.6%. So basically 5 out of 100 sellers are not getting more than their asking price. They might be getting exactly their asking price because that doesn't count in the over. 95 out of 100 sellers are getting more than they're asking Cupertino. And you can see everything is pretty much above 3/4, mostly right around 80% and above. There's a few exceptions, the expensive areas on both sides of the county, Saratoga, Las Gatos, Palo Alto, Los Altos, as well as Atherton. And then the coast is a little bit cooler at 67%. And then the condos are in right around 65% overall, would be my guess. So the condo market is a little bit slower. Going over to the magnitude, this is how much people are willing to overbid, and this is the average. And to give you some idea, the entire county is for Santa Clara County single family homes is 111%. And rough numbers, that would, if you looked at the median, that would probably be about 108.5%, because a few people are going to way overbid, which brings up your average, but doesn't bring up the median as much. The reason I don't use median, even though I'm a big fan of the median, I think median's a better benchmark for the magnitude of overbidding, is the median would be very close to 100% most of the time and really wouldn't show fluctuations. So you just have to keep in mind what this is. It's just a measure of what the market's doing. It's not saying that this is the midpoint, because that's not. The midpoint's closer to 108.5%. That's where half the people pay more than that, half people pay less than that. Some of the people that are paying less than that aren't even paying asking price, or paying asking price or below. So you just have to pay attention to what the numbers really mean. Cupertino Sunnyvale, 20% over. to give you some idea on the general range, it went from about 75% of asking price, which is exceptionally low, to about 150% of the asking price. And I won't even say that that's exceptionally high at 150%, but to get a 50% more than you're asking, you have to wonder. Now, I will grant some agents and sellers believe in pricing low and getting it bid up. So some of the overbidding is not paying over market value, but is paying over the asking price. So you can see the distribution. You can see condos and townhouses are quite a bit lower. So their color coding here is quite a bit different, much fainter shade of red. And then what we look at is price. And most people follow the median price, which is labeled 50 percentile. It's the midpoint. And that is the middle number through all these different micro market areas. So you can see it going down through here. The number to the left is the 10 percentile. So that is the cheapest you can expect to find. And the number to the right is the most expensive. I don't have the county-wide data on here. I will try to get that on there. It's a complicated algorithm to get this to work out. But anyway, you can see if we pick something like this one here, the moderate priced areas, which are Santa Clara, Campbell, Willow Glen, and Cambrian, those 4 geographical areas. The cheapest single family home is about 1.3. The median point is about 1.5, and the high end is about 2.5 million. So it gives you an idea of the range you can expect in each of the different micro market areas. For this week, which is basically happening right now, the green URL and the purple is what you're going forward to get to the different sites. So to get to the archive, you would type in tinyurl.com/REmarketGraphs. Starting in 2022, which is only 2 weeks away, it's going to be tinyurl.com/SVREMG for Silicon Valley Real Estate Market Graphs. And that would get you to the root URL. Both of these will work long term, but for the meetings, you'll have to start using the red. So for next week, use the green and the purple. For starting in 2 weeks, it'll be using the red. Hope that's not too confusing. I'll pause and see if anyone has questions over what we went over, and then I will continue on in detail. Any questions from anybody? Not seeing any questions, I'll move on. We're now looking at the number of new listings. So this is raw count. The blue line is the actual data for the number of new listings coming on the market for each week. The yellow line is the number of new listings that you'd expect. So up until about week number 39, which is basically Labor Day, right about here, I would say that the blue line and the yellow line were essentially on top of one another. From Labor Day forward, I would actually tend to support the belief that there's a little bit more new listings coming on the market than you would anticipate. So this is the first. It's not very much. It's probably about, I'm guessing, 7% up from where you'd expect it to be. So not a whole lot. And, that's only one side of the equation. So you have to look at both sides. But we are starting to get a little more inventory coming on the marketplace than you would normally expect to have. Flipping it over to total water in the reservoir, what level of inventory it is, and we're way below. And you can see we started off the year above, and this was about 40%. I think above normal. Fairly rapidly, we got down to normal. Then we got down to about 20% of normal. And now we're down at about 40% of normal. And at this time of the year, it's going to continue to fall just because it does, but there's no way we're going to recover. But that's not much inventory out there for people that are looking. This is the number of new offers coming on the marketplace. And this is the real story. This is about 15-20% above. The blue line is about 15-20% above the yellow line, which is your normal amount of offers accepted. You did plummet way down here for Thanksgiving, but keep in mind Thanksgiving fluctuates. So this was averaged over 2 weeks and not just 1 week. So that's why it dipped down. So this would have been above, and you can see we're markedly above again right now. And I'd expect the same thing to happen for Christmas. Now you're looking at days of unsold inventory over time, and you can see the 3 major components, which is the red line, Santa Clara County single family homes, the brown line, San Mateo County single family homes, and the yellow line, Santa Clara County condos and townhouses. So over time, we've been basically going down since, mid-August, late August, and probably associated with Labor Day, actually, September 3rd or whatever day it was this year. And you can see they've been basically coming down with the perturbation for Thanksgiving perturbing. You expect another perturbation over Christmas and New Year's. And, every holiday negatively impacts real estate except for Mother's Day and Valentine's Day, which has a slight positive impact. These are historical low levels. Yes, it was lower right here at Thanksgiving, but that was just a fluctuation. So right now is the lowest we've been ever as far as I'm aware of on this data. And I have that data going back to 1997, and I've been in the market since 81, and this is clearly the fastest market I've ever sensed. This is showing you a map of the DUI for the different micro market areas. This is single family homes only. The redder the color, the faster the marketplace is. It goes saturated red at 70. So at 7 days. So there's no difference between the 5.8 and the 5.2. And even the 7.8 is pretty close. It's pretty close to being saturated. I actually moved that this year because I think I used to cut it off at 22.5 days of unsold inventory with saturated red. And basically everything would be saturated red and you wouldn't be able to tell. So now you can look at it and you can see the cooler marketplace. It's down here in South County, up here in East South San Jose, over here in Saratoga, Las Gatos, Mountain View, Los Altos, Palo Alto, very slow in Atherton, Menlo Park. And when I say very slow, I got to caveat that because that's 37 days of unsold inventory, which is historically a very fast marketplace. And then over on the San Mateo County coast. Okay, so now we're going to the frequency of overbidding, and you can see we dipped down for Thanksgiving, but now we're back up at around, it looks like about 81.5%. And that's actually what the number was. 81.5% of the sellers are getting more than their asking price. And that's based on the macro data, Santa Clara County, San Mateo County, single family homes, condos, and townhouses that closed escrow in the past week. And I have to use closings to get the sale price. And so it's sort of a lagging indicator, but there it is. Here are your three major components. So the one that's doing the worst, and it's 70% of the sellers getting more than their asking price, it's not bad, is Santa Clara County condos and townhouses. Santa Clara County single family homes, the red line is doing slightly better at about 83% potentially. And San Mateo County single family homes is pretty close at probably about 78% of the sellers getting more than their asking price. So that's how common it is to overpay. This is the frequency overpaying on a map view. So the redder the color, the more overbidding. And again, you can start seeing the same areas: Morgan Hill, East South San Jose, Saratoga, Las Gatos, Palo Alto, Los Altos, Atherton, Menlo Park, Woodside, and the coast are the areas that are having the least frequency of overbidding. This is the magnitude of overbidding. This is how much people are overbidding. This is more of a sawtooth line. Both of these are more up and down than I would expect. I would have expected buyers to sense, but I guess both of the inventory that's being sold, the buyers, and the change in the market, it just fluctuates a lot more than I would have anticipated. It is 1 week's worth of data, so it's not a lot of data points. And that's one of the reasons I use 5 weeks is to try to get the data to settle down so you can see the difference between noise and changes in the marketplace. Because if you're here and you go to here, is that market really improving, or is that just a statistical fluke? Then you bounce back down and you bounce back up. So it becomes harder to see if there's a change. You can see a change here, but it takes several cycles to see that it's not been a change. It is a change in the market. It's not just a fluctuation. So basically starting in about week number 13, call it, you were basically flat. And I would say you were flat all the way up here. And I would almost argue there looks like there's a slight upward trend in the last couple weeks. Basically, what do I think happened? I think you started off the first of the year by right around the end of January, you started closing the transactions that were negotiated quickly for all cash, 2-week closings. Those started closing. So you started having an overbid contest going up. Then you get down to week number 15, sort of the middle of April, and you hit the plateau. And then the plateau was actually a little bit of an overshoot. So you had a little bit of a correction. And now we're coming back up and we're pulling in some of the appreciation from 2022 into 2021. And that's why I think the curve's going up now. And it doesn't show all that there, but that's a lot of experience, a lot of looking at the data, a lot of just gut feeling. This is the magnitude of overbidding broken down by the different geographical areas. Again, you can see the areas where the magnitude of overbidding is less. It's the same areas: Morgan Hill, South San Jose, East San Jose, Saratoga, Los Gatos, Palo Alto, Los Altos, Menlo Park, Atherton, Woodside, and the Pacific Half Moon Bay, the San Mateo County coast. This sale price to list price distribution curve. And again, the purple line is the current data. It's a little more bouncy this week because there's fewer closings as we get close to the end of the year, and that will be the case for the next probably 5, 6, 7, 8 weeks. Basically, between now and the end of January, you sort of expect the number of closings to dip. The last week in January, it will probably start going up again a little bit. So this is the last 24 weeks, 22 weeks of data, because I use 1 week for the best month, and the dotted lines are the monthly data. So the dotted blue line is the worst month, which was December 2001. The best month we ever had was April of 2018. And again, that's just because I used to do this stuff monthly. And then with the pandemic, I thought there would be a major shift in the marketplace, and there was. It's just in the opposite direction that I and everybody else was expecting it to go in. So the data in between is all weekly data. I didn't think it was worth the effort to go back and do 22 years of data 52 times to plot them each week. So I just plotted the month, and it just gives you an idea of your outer bounds. But with fewer number of transactions, the line is a little bit more bouncy than the other lines. But I also was commenting earlier that this line here is up higher, and it's the best we've ever had in a long time. And then down here, it's sort of in the middle of the pack. And so I think the steepness of this slope may change depending with the month. So at the end of the month, I think it might be a little bit flatter. In the middle of the month, the beginning of the month, it might be a little bit higher. And as the market tends to shift, I think the top end will tend to go up. So if this is the market shifting, that would also be an indication of the top end going up. Exactly why, I don't know. And it's the nuances that really isn't even in the data that I'm trying to pick up here. But you can see here now we're looking at the same data, but the last 12 weeks. So the last 4 weeks of the solid lines, they're sort of towards the top end. The dotted lines are towards the bottom end. So when I was saying it was bouncing around and plateauing, it now looks like it's starting to march up a little bit. So we came up, we plateaued and bounced around a little bit, and now it looks like we may be starting to march up. And the reason I'm saying that is these dotted lines are back in October, the dashed lines are back in November, and the solid lines are in December, roughly speaking. The dates are actually up here. So in general, what you're seeing is 3 of the 4 dotted lines are down here at the bottom. All the 4 dashed lines are towards the middle, and then the solid lines, 3 of them are towards the top and one's in the middle. So again, what that's doing is it's telling me there's a general progression from the lower amount of overbidding to the higher overbidding, which tends to indicate that buyers are feeling more pressure. This is the sale price distribution on a map for you. Again, we talked about the middle number being the median. That's what assigns the color. The lower number is the cheapest 10% in an area. The higher number is the highest 10% in the number. So quickly you look at this, and this is single family homes only. So you look at it rapidly and you can see where the cheaper homes are to purchase. This is looking at just the median sale price for the different micro market areas. The red is Santa Clara County single family homes. The gray brown is the San Mateo County single family homes. And the yellow line is condos and townhouses in Santa Clara County. If it's not apparent, I will point out that condos and townhouses tend to be more price stable. You look at single family homes, you could argue there was a little bit of an overshoot here, come down, correction, came back up, dipped down, went up dramatically, continued to climb, did a little overshoot, came back down, and now it's starting to climb. But if you look at the condos and townhouses, it's pretty much a constant slow up. So it's slow and steady on the condos and townhouses. And there's a lot of reasons I could justify that. Which one's accurate, it really is immaterial, but you don't have the huge price appreciation followed by a little overshoot followed by a correction that you tend to have in single family homes. This is just a gut check of the different metrics that are important. It's sort of to make sure my data's right, keep myself accurate. So in other words, there's a lot of processing that went into the data to get to where we're looking at. Now we're just looking at some raw numbers off the computer pretty closely. We're looking at this week versus last week, and this is the percent of inventory compared to the 5-year median. Again, the 5-year median is 15 through 19. So right now in Santa Clara County single family homes, you only have 37% of the homes you'd expect to have. If you go up just to San Mateo County, you have 56% of the homes you'd expect. So San Mateo County agents may be saying, we have no inventory, but they have significantly more inventory compared to normal than Santa Clara County. If you go to Santa Clara County condos, you're at 91%. And then if you go to San Mateo County condos, they actually have twice the inventory you'd expect it to have. So, and then the numbers over here are the last week. And this is based on active listings that are currently on the market. This is your current inventory, just what's out there for people to buy that doesn't have an underlying contract. And then the next number is DUI, days of unsold inventory. And the reason I have offers on the top is this requires offers to be accepted over a period of time to calculate this number. And so based on the last week, it was at 17.6, up significantly from 13.8. But it's 1 week. We had a week where we had less inventory come on the marketplace. We have the holiday coming up. People are distracted. 1 week doesn't bother me at the least. If you look at San Mateo County, this actually was exact match. I did double check that data already. In Santa Clara County condos and townhouses, it slowed down by a full week in a week. That's the level where if this was 5 weeks of data and it continued for 2 weeks, that would be the point where I start saying the market's shifting. This is just a holiday impact, and that's where experience comes in. You have to realize, and that's one of the reasons I have so much data, is just the way the market is. Some data is more significant at different times of the year, and at some times of the year you can't trust the data because the market, the seasonal fluctuations are so great. And then you go down to the Bay Cities condos at 28 days, up from 22. So if you look at it pretty much across the board, exception being San Mateo County single family homes, the market slowed down significantly from last week. But I think what happened is there was less new listings coming on the marketplace, so we could have fewer sales. And if you have fewer sales, your rate of sales drops, which causes the DUI to increase. Then we're just looking at frequency of overbidding, and I consider 33 to 50% to sort of be the normal range. And you can see that we're way above the normal range, which puts you in a hot seller's marketplace. And that's why all these numbers are red, except for these over here. If you have double the inventory, that would tend to indicate a buyer's marketplace, but all the other indicators are red. Now, granted, this should be blue too. Sorry about that. That's a negative appreciation, which is clearly an indication of a buyer's marketplace. But 81% in Santa Clara County, 77.5% in San Mateo County, 67 and 60% for condos and townhouses. So you can see sellers across the board are getting more than their asking price. Not 100% of the sellers, but an awful lot high percentage of the sellers are getting more than their asking price. This is the magnitude of overbidding. Same concept this week versus last week. I consider it to be 99 to 100 and 101.5% to be sort of the normal range. You're clearly well into the seller's marketplace on these indicators. And then we have appreciation. This is peak appreciation for the year, and this is current appreciation, and that's over not a year ago pricing, which I could do, but that would bounce because if you did it against a year ago, your benchmark's fluctuating as well as your current number. So I took all of 2020 pricing, came up with a median for that, and I'm comparing the current median to the base median of all of calendar year 2020. So you can see we got up to 24, almost 25%. Then right now we're at 21%. We actually dipped down to, I think it was 16.4%, if I remember correctly. And so you've dipped down and now you've recovered some of that. It's very noteworthy in my book, and I'm not sure I understand it, but the Bay Cities was up to almost 16% appreciation over last year. Now it's down at 9% below last year's pricing. So this should be a blue color, but prices in San Mateo County Bay Cities, which are things like San Mateo County, Foster Cities, Redwood Shores, Burlingame, Belmont, San Carlos, Redwood City, those condominiums in those communities, everything on the base side of the ridge line essentially are actually selling for less money now in 2021 than they did in 2020. And I don't think most people would believe that. So here is your breakdown of the micro market areas. This tells you when the median price occurred in 2020. And it's when the median escrows closed. So half the escrows closed before August and half closed after August, and the median price what it was. So we're 21% above this 101.370 median for all of Santa Clara County single family homes, and that should get you to some number around 1660, which I think is what the median is. So the week that's highlighted is the peak pricing for the year. So here countywide, your peak pricing was 24.4%. It was sometime in the past, but all your micro market data is out over here. How do you explain that? You've had a shift in the marketplace. So individual property values are probably getting close to their peak for the year right now for all these areas. Well, they are for the areas highlighted, and even these aren't that far back, but this is a market mix shift. So if you're selling more lower priced homes now than you were in the beginning part of the year, that would explain why the county-wide median price went up. So this is why it's important to know what you're talking about on data, because you can make data say anything you want it to. And that's why when the media comes out and says things like the Bay Area prices are up or down X%, that has nothing to do with property values of a given property, because here, all these areas, which are the bulk of Santa Clara County, are at their high price for the year. And yet the county-wide pricing is not at their high price for the year. And then you come down to San Mateo County, you can sort of see the different years a little bit more spread out. So what that's tending to say to me is Santa Clara County is starting to appreciate again, because you had the peaks back here. These were the previous high peaks. And you can see the new high peaks are higher than that. Not necessarily by a whole lot, 0.5% in the case of Cupertino Sunnyvale, 5% in the case of Campbell, Cambrian, Willow Glen, Santa Clara, about 4% when it comes to Santa Teresa, Blossom Valley, Milpitas, and North Valley, and actually about 4% when it comes to East, South, Central San Jose. And for the South County is actually 3% below the previous peak, and then current peak here is 32. So the previous peak was what's off the chart, since we can't see there. I can't get that much data on here. This is looking at the slide that we discussed before in detail. I normally discuss it here, but since we've already done it, we'll pass it over. This now is looking at a couple things. The next two slides, the formats are very similar. This is December data, which is from December 1st through January 4th, collected on January the 5th. Well, a smart person would ask, well, how, if this is data collected on January the 5th, how do you have the data now? Because we're not there yet. It's because for 2021, I cut the data off last night at midnight and I go back in time for 35 days. So I'm still using the 5-week period and I'm getting as close to matching as I can. And so you have to realize that it's not a true apples and apples comparison. But what is the takeaway? The takeaway is you have 240 active single family homes in Santa Clara County. How's that stack up? Well, the lowest year we had was 2018 at 291. I expect this number to continue to go down. Whatever number we end up at, it will be the record low, because right now the record low is 291. If I had to take a guess, 150 maybe? There's no way to know, but it's going to be an astoundingly low number. Maybe we'll only get down to 200, 175. And any number you want to throw out there is as valid as another number until we actually get there. It will be below 240. That I can almost guarantee you. This is the median square footage, the average bedrooms and bathrooms. Then you start getting into things that make sense. This doesn't really make sense in a lot of ways because this is what's on the market. So it's overpriced turkeys. It's all kinds of things that aren't really reflecting it. Once you get into offers, this is what's selling. So the median days on market for what's selling is only 8. And if you look back in time, that's a record low. I don't expect this number to shift significantly one way or the other. The average number of days on the market is 18. If you look back, 24, 22 are your previous low numbers. So the fact that you're 18 just shows the market's higher. Here's your DUI. This is the actual theoretical number, 11.8 days on sold inventory looking back over 5 weeks. I do expect this number to increase, but will it increase and catch 18 and a half? I don't think so. It's hard to tell. sell. It's going to be going up in that direction. Anything can happen. Number of sales, I expect this number to be dropping. So it will probably get below last year's number. But I think the reason we're below last year's number is last year we had way more inventory. The inventory should be up here somewhere. Average inventory 415. So you had not quite double the inventory. So the pace of the market was slower, but you had more sales. And the sales, I would actually say sales are being limited now by lack of inventory. I mean, until recently, I never felt comfortable saying that because we had times where we had less inventory and had more sales. So if you have periods of time when that happened, you can't be restricted by the inventory. I don't think I'm aware of any time where we had less inventory and more sales because we're at record low inventory. So I think we finally hit the constraint point. Where exactly it is in that line, who knows, but it's north of 300 homes for Santa Clara County, for example, because now we're at what, 240. So it's probably somewhere 300. It's under 500 homes, because we've been at 500 before, and I don't think we've ever been restrained before. But now that we're down under 250, I do believe we're being restrained by the lack of inventory. This is the median square footage and average bedrooms and bathrooms. Closings, now you get in the sale price, 110.8%. I don't expect this number to change. It's currently outperforming 2018 at 109.5. I think that will continue. The 81% overbidding outbids everybody by quite a bit. I don't expect that to change in one direction or another. Here's your 10 percentile pricing. $1 million is the cheapest you can really expect to find a single family home in Santa Clara County for. Your median is approaching 1.7 again. Your 90 percentile is 3.5 million. The number of sales and this is actually the number of closings on the 5th, would be about 1,012. This number will drop down, so it might get below the 917. I don't think it will get below 800, so it might be second to last year. And again, it's the lack of inventory, and then your median square footage. So in that way, you can compare things going back for 20 years. This graph our table is an apples to apples comparison because now it's looking at November. But the reason I spend more time on December data is this is looking in historical data. I'd rather try to look at current data because this data ended on November the 5th. I gathered it on December the 6th, and we're frozen in time and looking backwards. So to me, I'm not going to go into it, but it's the same format as the previous slide. And with that, I should be all finished and open for any questions if anyone's got any for me. Any questions? Not seeing anybody. Everyone have a safe holiday season and see you next week. I will be live at 9 o'clock, and call me crazy, but the handout is already posted. And for those that are paying attention, sometimes I don't get the video up, but the handout is much quicker time-wise, so that will be up there. So it's the green-purple combination. Starting next year, it will be the tinyurl.com and then the red. All right, take care, everybody. Bye for now.